Good evening, everyone. Uh, to, and tonight we are looking at MBA 634, and the topic before us is capital structure. Capital structure. Only on four subtopics. We'll be looking at introduction, theory of capital structure. Then we take some questions and answer. I want to just tell you something. First semester, MBA 639. General concept of accounting. We were introduced to income statements, balance sheets, and there's a balance sheet is talking about accounting equation. It's talking about our accounting equation, and when we say accounting equation, it's just telling you about the position of our what? Assets, liability, and capital. And we said equation 1 had to do with assets equals to capital, which is equation 1. I will say assets are the resources deployed into the business, while capital is in form of owner's equity introduced into the business. I will said equation 2 has to do with assets equals to capital plus liability. I will define liability as money borrowed, money you borrowed to do business. Capital is the money that the owner introduced into the business. Now, this topic is telling us about the structure of our assets, of our capital. That is, what makes up my capital? How many of my capital? What percentage of my capital is equity? It's talking about my capital structure. What percentage of my capital is equity, that is owner's fund, and what percentage of my capital is debt, that is money that I borrowed. So that is the essence. First semester, we just got a figure. Capital is 10 million. But in this semester, we are going a step further to say my capital can be made up of equity, debt, and preference capital. So which of these three do I use in my business? And what is the percentage of each of them in my business? So this is the essence of this. Because as a businessman, as a manager, I need to know the percentage of what I have in my business. Am I too exposed to my creditors? If I introduce my own fund into the business, am I getting returns for it? Because for every capital introduced into the business, they come with what we call costs. The cost of equity, and there's also cost of your debt. So what is the cost of my equity fund? And what is the cost of the debt? For me to know whether I'm too exposed to creditors. And if I'm doing well as an equity shareholder, what is my return at the end of the year? That is why this topic is very, very important as a manager, to know what makes up your capital, to know when to take off debt and when not to. Because the cost of debt is going to be paid to the creditors. The creditors will give you at cost. And don't forget, you pay interest out of your profit before you can pay anything to equity holders. The equity holders are also called the residual owners. That means at the end of the business, whatever happens, they are going to bear the brunt or get the blessing at the end of it all. But first of all, you must pay the interest on your debt, which is the cost. The cost of your debt is what we call interest. While the cost of your equity, that is the return to your ordinary shareholders, is what we call dividend. And there's no law that says you must pay dividend. But of course, you must pay your debt. It's compulsory you pay your interest and you pay back your debt. But to your equity holders, you pay their dividend after you must have paid your interest and also what we call tax to government. So equity shareholder, in the real sense, though they are the owner of the business, they put their money down for the management to run the business. But if they don't do well, they bear the brunt. So before, as a manager, before you go on and take debt, you must know the cost of the debt you want to take, so that as you incur debt, you remember also the equity holders. So that is basically what this topic is talking about. What is the structure of my capital? What percentage of debt am I using to finance my business? What percentage of equity am I using to finance my business? You need to know this for you to be able to strike a balance, to know when to take up more debt or to use equity, to call on the shareholders to put money back into the business. Please, I need you to open your mind, because this topic is very interesting and it's interactive. It's something that will come about day to day in our business. So we need to know it as managers. All right, now we have theories of capital structure. We have two theories of capital structure that we are going to look at. The first one is the traditional theory, while the other one is what we call Modigliani and Miller, M and M. Now, the essence of this theory is just talking about the capital structure. What do you need to do to have a wonderful capital structure? Now, these theories are based on the following fundamental assumptions. Very key. These assumptions are very key. The first assumption is that the company employs only two types of capital, that is debt and equity. All the earnings are paid out as dividend. This theory, one of the assumptions is that there's no retained earnings. All earnings, that is all profit made, are paid out as dividend. No retained earnings. But of course, you agree with me, in the real sense, in the real life situation, you don't pay everything as dividend. You retain certain percentage for expansion. But according to this theory, everything paid as as dividend. There is a gearing of company, which can be immediately done by issuing of debt to replace shares or issuing of shares to retire debt. So that means if you want to change your gearing, what do we mean by gearing? Gearing is just talking about using debt and equity. A company that is highly geared will use more of debt than equity. A company that is less geared will use more of equity than debt. So the assumption is telling us that for a company to change its structure, it needs to take more debt to replace shares, ordinary shares, or to do vice versa. Then another thing that is interesting, no transaction cost. But in real life, is there anything you are going to do? Is there any transaction you are going to do that will not involve cost? It's not possible. But according to this theory, no transaction cost. Then another thing, operating earnings of the company are not expected to grow. Operating earnings, that is operating profit, are not expected to grow. This assumes that there's constant what? Capital structure. So operating earnings are not expected to grow, which is not the case in the real life. Taxation for time being is ignored. Can you also ignore taxation? It's not possible. But these are just the assumptions. And you know, in the real sense, others have also come up with other theories. They have also come up to say no. In the real sense, taxation cannot be ignored. Operating earnings can never be said to be what? Static. It must change. It must grow, because there is need for growth, and you don't pay everything as what? As dividend. So they have also come up to counter every of these assumptions. Now, let's go to traditional theory. It's telling us that debt of a company increases, that as debt increases, what happens? The return required by the ordinary shareholders will begin to rise. The more debt you take, the more cost of equity you are going to pay. Why this? Equity shareholders, they are the owners of the company. They put their resources down to do business. For instance, if they have requested for 10%, and you have gone ahead to say, okay, because of expansion, I want to go and borrow debt. They begin to see what? They begin to panic, because they know at the end of it all, you are going to pay interest on debt before you pay them dividend. So the more you go out to take debt, the more also they will increase their what? Their returns. Now, equity providers will start to get worried, as I've said, about the adequacy of operating profit to meet the huge debenture interest. That means you need to now do more to be able to pay the interest on debt. So they begin to get worried that what if you pay everything, all the profit made as interest, what will now be their lot? Equity providers will become worried also over the possibility that the pension holders can interfere with the management. There's no equity holder that want to dilute their interest. They want to be in charge. They want to control the business. But the more you go to take debt, the more you are watering down their control. So they will be worried. Then there's possibility of what? Forced liquidation in case of failure to meet interest. Once you fail to meet interest on debt, the debtors, the creditors rather, they can come in and say we want to take over the company. So equity holders, they are worried. Then another thing, the higher the level of operating income will be required to meet the over increasing what? Debenture interest. You need to make more money, more profit to be able to cover your what? Interest. That's what we call interest cover. Interest cover. You must make enough money to cover the interest you are going to pay on debt. So equity holder, they will become worried. Finally, there may be no physical asset to secure additional debenture. Debenture, debt also come with what we call lien on assets. They can place a lien on your assets that if you default, the asset is going to be taken over. So ordinary shareholders, asset that you use in operating, they can take it over. So ordinary shareholder, they are worried. Now, let's look at M and M. What did they say? M and M. They say there's what? Relationship between the leverage, cost of capital, leverage, cost of capital and the value of the firm. M&M, they are of the opinion that given a set of assumptions, the capital structure and its composition has no effect on the value of the firm. That means your cost of capital, the value of the firm, and the relationship between your debt and equity has no effect on what? On the value of the firm. Why did they say that? M&M said there's nothing which may be called the optimal capital structure. What is optimal capital structure? Optimal capital structure is basically talking about the level at which the costs of capital will be at optimal level, that is the highest point. And after this highest point or optimal point, the value of the firm becomes what? Negative. What attracts debt? What makes a firm go out to look for debt over equity? Because cost of debt is cheaper when compared to cost of equity. But optimal capital structure now is telling us that the more you go to borrow debt, it will get to a point, a maximum point, when the more debt you take, the less it will have for your value. That means the cost will become higher, then the value will be reducing, which is counterproductive. So that is what they are saying. And they are also saying it's not possible to say, okay, there won't be growth. The security are embedded what? Divisible. You can decide not to take 100% of something and divide it. Let me take 70% and 20% elsewhere and 10% elsewhere. Investors are rational and well informed. Investors, they know what to do. They have information. They operate in an open market, free entry and free exit. They have information to make a rational decision. They know when to buy and when not to buy. They can quickly take what we call arbitrage. If there's something that is high in a particular market, they can sell it off, go to another market and make the money. So what they are losing in market A, they can gain it in market B. They have all information. They are what? Rational. Very, very rational. So they can take personal leverage against what? Corporate leverage. So they can take their personal decision because they have information. Now, the value of the firm is equal to capitalized value. The total value of the firm, according to M&M, is independent of what? Financial mix. What do you mean by that? The value that you have as a firm has nothing to do with what? The financial mix. Whether you use more of debt to equity or whether you use more of equity when compared to debt, is telling us that it has nothing to do with it. So the value of your firm will depend on what? The class of risk you belong to. It depends on what? How you are able to use your asset, your investment to make it more money. That is what they are talking about. Let's just take an example. All the story we'll be talking about, let's look at it. What do you mean by this? Question 1. A firm has an operating income of 150,000 naira. Now, operating income can also be said to be what? Our profit before interest and tax. Profit before interest and tax. The profit you make from operations before you pay the interest to the debenture holder and before you pay the tax to the government. So anywhere you hear operating income, is talking about profit before interest and tax. A firm has an operating income of 150,000 naira. It employed no debts at all. At that point, equity holders are expecting 10% dividend. That means when the firm has no debts in its capital structure, equity holders requested for 10% of dividend. Subsequently, going further, the concern borrows 6% debenture for 300,000 naira, which means the company goes out to borrow money, that is debt, which leads the equity shareholders to expect 11% what? Dividend. Now, if you look at the assumptions under the capital structure, tells us that the more the company goes out to get debt, the equity shareholders, they become worried. And what happens? They increase their own returns. They increase their own what? Expectation. At the point when the firm had no what? Had no debt, the equity holders expected what? 10% dividend. Now the company has gone to look for what? 6% debt of 300,000 naira. Now the equity holder, they've increased their what? Their returns from 10 to 11, 1%. Further, when the concern, the business borrows total of 600,000 naira by issuing debenture, the debenture holder demands 7% interest. Equity holder did what? As expected, they increased. Now the company has taken how much now? How many? They've taken 900,000 naira what? Debt. The first debt of 300,000 at what? At 6% interest rate. The second debt of 600,000 at what? 7% interest rate. Equity holder, what did they do? Initially, they had 10% at no debt. With 300,000 naira debt, they asked for 11%. With 600,000 naira debt, they requested for what? 12.5% dividend. You can see that it's growing. Now, the question says, calculate the value of the firm according to the traditional approach under these three situations or conditions. The first one, unlevered. Unlevered means firm without what? Debt. Or we can say is what? Ungeared. Ungeared. That means with no debt. Then, with 300,000 naira debt at 6%, what will be the value of the firm? There are 600,000 naira debt taken at 7% interest rate. What will be the value of the firm? Now, this is the question we have. We first need to analyze this question. Now, let's analyze this question. We have our what we call operating income. Operating income. And how much is the operating income? We are told that the operating income is 150,000 naira. 150,000 naira is the operating income. 150,000 naira. And we said that once you take up debt, what do we need to do? You pay the interest before you can pay what? Dividend. Now, less interest. How much is interest? Nil. Because we are looking at the first scenario. That means on what? Unlevered. That is no debt. No debt. At this point, there is no interest to be paid. Then what do we have as balance? We have 150,000 naira. Now, this is what we call operating income after interest. And this is operating income after interest, which invariably means this is the dividend available to the ordinary shareholders, because after we might have paid our what? Our interest, then the balance is what? Dividend available to the ordinary shareholders. But you know, one of the assumptions says we should ignore what? Ignore taxation. So taxation is not coming. So we assume everything here is what belongs to the ordinary shareholders. The question says we should calculate what? The value of the firm. Don't forget that it says we should calculate the value of the firm. How do you calculate the value of the firm? The value of the firm will be what? Value of the firm is equal to value of equity plus value of debt. That means we need to first get the value of equity, then the value of debt. Going back to the question, we have in the first case no debt. That means the value of our debt will be what? 0. Now, what will be the value of the debt when the consigned borrow 6% debenture for 300,000? The 300,000 will be what? The value of the what? Of the debt. How did you get that? At the point when you are taking up the debt, you already know how much you are taking and at what interest rates. So there's no hidden what? No hidden value. You are taking 300,000 naira at what? 6%, stated at the beginning of what? Taking the debt. For the second option, we have 600,000 naira at what? 7%. So when you are taking it up, you already know that the value of the debt is 600,000, and you are also aware of what? The interest rate, 7%. But do you have the value of the equity? We do have value of equity. So value of equity is not stated, but it needs to be what? Calculated. How do we calculate value of equity? Recall that value of firm is equal to value of equity plus value of debt. Therefore, value of equity. How do we derive value of equity? We have KE equals to dividend over market value, where KE equals to what? Cost of equity or returns to ordinary shareholders. Why dividend is what? The dividend paid to ordinary shareholders. KE is in what? Is in percentage. Why the market value is what? Is what we want to derive. Do we have cost of equity in our question? What is our KE? Cost of equity. Now, if you look at it, at the point when we have no debt, our cost of equity at that time, the equity holders are expecting 10% what? Dividend. That is what? The cost of equity. The equity holders are expecting 10%. This is our what? KE, cost of equity. That is our cost of equity. Now, look at this. We said after paying your interest, whatever is left is what we call dividend that will be paid to the ordinary shareholders. Remember the assumptions? Ignore taxation. Another assumption says all earnings are what? Shared as dividend. No retained earnings. No retained earnings. That means after you pay your interest, you pay the balance to what? Shareholders as what? Your dividend. That is what the assumption says. Now, let's go back to this. That means from there, we know what our KE is. Our cost of equity, which is 10%. Then our dividend, that means what we have left after paying interest to the debenture holders. So KE equals to dividend over market value. If you want to make market value the subject of the formula, what do? We cross multiply. Then we have KE into MV equals to what? Dividend. Over cost of equity. Therefore, market value from our question, what do we have as our dividend? 150,000. And our cost of equity from the question says what? 10%. So which is equal to what? 0.1. If you divide 150,000 naira by 0.1, what do you have? Alright, this gives us what? 1.5 million. 1,500,000 naira. This is the market value when the company has no what? Has no debt. Now, going further, the question says when the company does what? When the company has 300,000 naira debt at what? 6%. What will be the value of the firm? Will the value drop? Will the value increase? Now, how do we do this? Don't forget, we still have the same what? The same operating income. 300,000 debt at 6%. Operating income is what? 150,000 naira. Less interest. And how do we calculate our interest? If be given is 6% of what? Of 300,000. 6% of 300,000. What would that give us? Naira. So that means we are paying interest of what? 18,000 naira. Now, take away the interest from the operating profit. You are left with 132,000 naira. This 132,000 naira belongs to who? The ordinary shareholder, which is what we call dividend. It belongs to the ordinary shareholders and is what? The dividend. We want to calculate what? The value of the firm. Don't forget from the first question, we are to calculate the value of the firm. But can you see we are calculating the value of equity? Then how do we get the value of the firm? We have not calculated the value of the firm. We have only gotten the value of equity. Now the value of equity gives 1,500,000 naira. So what will now be the value of what? Value of the firm. And we said the value of the firm is equals to value of equity plus value of debt. So therefore value of debt is equal to what? 0, because there is no debt. Therefore value of firm will be equal to 1.5 million naira, which is the same thing as what? The value of equity. Because at this point the company has what? No debt. Now let's compare that with the second question, the second situation. Now we need to calculate what? The value of equity. Recall KE equals to what? Dividend over market value. Then why the market value will be equal to what? Dividend over what? Cost of equity. We did this together the other time. Now what is our dividend? Our dividend has dropped to 132,000 because of what? The 18,000 naira debt interest that we paid. Now what is the cost of equity? Now at this point the ordinary shareholders, they requested for what? They requested for 11% what? Dividend. That means 11% what? Cost on their fund. So 11% cost. So we now base our dividend over what? That's 11%. So it gives us what? 0.11. So now it has dropped to what? 1.2 million naira. Can you see? When the company has no debt, the market value of equity was 1.5 million naira. Now the company has gone up to take what? Debt of 300,000 naira at 6%. What happened to the market value of equity? It dropped to 1.2 million naira. That means the more you go out to take debt, the more equity old shareholders their returns will be, but there will be a drop in their what? In their dividend. Dividend dropped to 132,000 from 150,000 naira. Why? The cost to them increased from 10% to 1.2 million naira. Now let us look at the effect of that on what? The company's market value. We want to look at that on the company was market value. Therefore, the firm market value, which is value of equity plus value of debt. In this question, what's value of our equity? 1.2 million naira. Then the value of debt, I said it earlier, the value of debt is that actual amount that you took as debt. You took 300,000 naira at what? 6%. So that 300,000 naira is what? The value of what? Of the debt. At the point of taking the debt, you already know what the value will be. Now, look at our overall market value of the company is still what? 1.5 million naira if you add the two together. So it has no significant effect or no effect at all on the value of the firm, but surely it add on the value of what? Of equity. Now let's look at the third scenario. What will be the effect on what? On the value of the firm. The third says at 600,000 naira debenture, what will be what the value of the firm? The company went to take 600,000 naira debenture at 7%. What will now be what? The effect. Now let's go and check that out. At 600,000 naira debt of 7%. Sorry, this is 7%. So now let's look at the effect. Don't forget, you are starting with what? Operating income. You have the same operating income of how much? 150,000 naira. The next thing is to take away what? The interest less interest. How do we get the interest? Don't forget what we did earlier. The interest will be what? It will be 7%. 7% of 600,000 naira. So the interest will be what? 7% of 600,000 naira. That is 600,000 times 0.07. That gives what? 42,000 naira. So the company now is paying what? 42,000 naira as what? Interest to the debenture holder. The company is left with 108,000 naira, which is what? Ordinary shareholders what? Dividend. Since the assumption says the company retained nothing, the company pay every earnings what? As dividend. Now let's look at the value of equity. They call the formula which says market value equals to what? Dividend over cost of equity. In this case, what do we have as a cost of equity? What did the ordinary shareholders ask for at what? At 600,000 naira debenture. They increased their what? Cost to 12.5%. They increased it to 12.5 what? Percent. So that means 12.5%. Now, how do we calculate that? That says what? Our dividend, which is 108,000 over 0.125, that is 12.5%. So what do we have as our final answer? So now we have 864,000 naira, which means the value of equity has also what? Has also dropped. Earlier, we had values of equity to be 1.2 million at no debt. Now, what do we now have for the second one? Well, we took 300,000 naira debt. What do we have as our what? We have 1.2 million as the value of equity. But the value of equity has dropped to what? 864,000 naira. But as these values were dropping, the cost of equity was what? Going up. It went from 10% to 11%, now to 12.5%. What is the effect of this on the value of the firm? Which is what the question says we should calculate. Therefore, value of firm which is equal to value of equity plus value of debt. What is value of equity now? Don't forget, 864,000. Then what do we have as our value of debt? Don't forget the same 600,000 naira that was borrowed, 600,000. Now the value of the firm will be 1,464,000 naira. Did it drop? Let's look at it. Now, the value of firm at no debt was 1.5 million. The value of debt at 300,000 naira debt of 7% is what? 1.5 million. Now, the value of debt at the value of debt at 7% now take the value to what? 1.4 million naira. Can you see now? That means the more you go to borrow, the more interest the equity shareholders will ask for, the more return they will ask for. Don't forget the cost of equity is cheaper to cost of debt. But what about the effect on the value of firm? The value of firm moved from 1.5 million now to 1.4. And the value of equity dropped from 1.5 million to 864,000. To 864,000. And one of the assumptions says there is no retained earnings. That means we paid everything as what? Dividend. So this goes to tell us that though the cost of equity is cheaper compared to the cost, though the cost of debt is cheaper to the cost of equity, however, the value of the firm keeps dropping the more you go out to take what? Debt. Now, what is now the effect of all this on the cost of fund to the organization? There's something we call weighted average cost of capital. That is, we call it WACC or KO. That means what is the average of this cost to the organization? What will be the cost? Will the cost of the organization go up by the time you go to borrow, or the cost will drop? So is it positively or negatively what related? Now let's test it out. At no debt, at 300,000 naira debt, then at 600,000 naira debt, how do we get the value of firm? We can get this from our value of equity. When we say the value of market value of equity equals to dividend over what? Cost of equity. Now, what is the cost to the firm? That is what we want to get. We can say value of firm, which in this case is replacing the value of equity, equals to earnings, the total earnings, which is the same as operating income, over what now? Over KO, which is the cost of, which is the weighted average cost of capital. That is the cost of fund to the organization. At no debt, what do we have as a value of firm, we had 1.5 million. And what do we have as our what? Earnings. Earnings is not changed from 150,000. Now, if you put this and you cross multiply, KO will give us 150,000 over 1.5 million. What would that give us? That will give us, should give us 10%, right? That give us what? 10% at no what? Debt. That means the cost of fund to the firm, to the organization, to the company is 10% at no debt. Now, the company goes further to take what? A debt of 300,000. What would that be? Which is the same thing as this, earnings or operating income over KO. Don't forget, KO is what we are looking for. Now, they add what now? 1.5 million naira as the value of firm under the second instance. 1.5 million equals to the same earning. Now, if you go through this, you see that we still have the same what? Cost of fund to the organization. Our KO or WACC will still be what? 10%. Now, let's look at the third instance. Our value of firm equals to earnings. I'm rewriting this formula so that it can stick as we are working towards other examples. Value of firm at that point was 1.4 million 64,000. That is don't forget the same 150,000 over KO, which is what we want to calculate. So that gives us 150,000 over 1,464,000. So what do we have? So that's 10.2%. So that means the cost of firm has now moved to what? 10.2% from 10%. So that means the more the company goes out to take more debt, the cost of fund will keep what? Will keep growing, which is against the plan of the organization. Capital structure assumptions tells us that the more debt you use, it will have a negative effect on your cost of capital. That means your overall cost of capital will what? Will be reducing. Now, the overall cost of capital moved from 10%, where we took 300,000 naira debt, it remained 10%. But at the point when we got to what? 600,000 naira debt, can you see that the cost of capital to organization now started going up? At this point, the company is at optimal value. It cannot go further to take what? Debt. Because the more debt is take after this, is the value will keep dropping. The value has already dropped to 1.4. The cost is now going up. And the excess of capital structure of taking more debt is to increase the value of the firm and to force the cost of fund to organization to what? To drop. But we can see the reverse is the case at the level of taking what? 600,000 naira. This is where we are going to draw the curtain tonight, and don't forget what we have learnt. Don't forget where we started from. We started from what capital structure is all about. Then we went to the theory of capital structure for us to now solve examples. Debt and equity. The more debt you take, is it the better for the organization? The more equity you allow, is it the better for the organization? But there's what we call optimal capital what? Structure. At the point when the cost is at the lowest and the value of the firm is at what? Highest. So the cost that gives the lowest cost of fund and gives the maximum value to the organization. At this point, the company is at what? Maximum or optimal capital structure. Thank you. Till we meet again. This is yours, Mike from Prestige Tutors. Thank you for listening.